Hello, and welcome to the Credit Compass, your guide to navigating European credit markets. Each week, we unpack key developments in credit, explore macroeconomic trends shaping the landscape, and dive into the strategies that matter most for investors across Europe and the UK. Whether you're a fixed income veteran or just getting your bearings, we aim to make the complex world of credit more transparent and actionable. This week, we're exploring the evolving outlook for default rates, informed by Deutsche Bank's annual default study, and we'll also examine recent UK economic data that may influence the Bank of England's policy path. Alongside that, we're bringing you insights from the Global ABS conference in Barcelona, where the securitization market is gathering momentum. All right, let's delve in. Let's start with Deutsche Bank's default report released on Monday, the 9th of June. While the report is global in scope, we'll focus on what it reveals about Europe. Their message is cautiously sober. The bank characterizes the European credit cycle as being in a late stage, with a modest upward drift in defaults projected through the next year. Specifically, Deutsche Bank's model anticipates euro-denominated speculative-grade defaults rising from the current 2.1% to 2.3% by year-end, then holding steady through mid-2026. While that forecast may seem relatively benign, it's important to interpret it in context. This modest trajectory reflects average recession odds aided by ECB rate cuts and generally lighter corporate leverage compared to previous cycles. Policymakers, according to Deutsche, remain borderline tight by historical standards, meaning they're unlikely to ease further unless faced with a clear downside growth shock in Europe. So while conditions may appear stable, investors should be cautious about mistaking that stability for the kind of monetary support seen in prior downturns. The story in the UK is a bit different, as we will outline later. More broadly, distress ratios across high-yield and leveraged loans have crept back into the middle of a 6 to 10% range, markedly above the post-global financial crisis lows. And what's notable is that this is happening without an official recession. That tells us that investors should remain wary, pricing in persistent credit risk even amid ongoing economic expansion, albeit slow. Deutsche also highlights a subtle but important change in how credit stress is manifesting. They are seeing fewer outright payment defaults and more distressed exchanges, a trend that made up 64% of global speculative-grade defaults last year. That's an all-time high. These restructurings help soften default statistics in the short term, but they may actually mask deeper fragility by pushing risk into the future. Recovery rates, how much creditors ultimately get back, could prove disappointing if growth doesn't deliver. From a valuation standpoint, spreads are offering less and less compensation for risk. Deutsche points out that high-yield spreads across US dollar, euro, and sterling markets are sitting near the tightest levels in the post-1998 era. Let's take the UK as an example. 5-year sterling-denominated high yield is trading at around 450 basis points. According to Deutsche, that level effectively prices in a 5-year cumulative default rate in the mid-teens and not much more. The margin for error is thin. If their benign case doesn't hold, those spreads leave little cushion. Digging deeper, there's considerable divergence hidden beneath the calm surface of that 2.3% forecast. Sector-level stress remains a critical factor. Market pricing reveals that distress is not evenly distributed. In euro high-yield bonds, there is weakness in sectors like telecoms, healthcare, and retail. For euro leveraged loans, the pressure is showing up in healthcare once again, as well as consumer staples and electronics. That clustering of stress tells us where the vulnerabilities lie, and it's not a coincidence that many of these sectors are interest rate sensitive or still dealing with post-pandemic structural shifts. So what do we conclude from this? Implications for both UK and European investors are focused on being selective, as we have highlighted before. The headwinds, such as higher real rates, even within historical norms, and lingering tariff and growth uncertainty, will challenge leveraged investors to avoid troubles. As highlighted within the report, some sectors are more likely to be impacted than others. With spreads thin, recovery assumptions matter more than usual for investors. As a result, investors should remain diligent in their assessments and remain cautious and prepared for volatility. Speaking of challenges, the UK is facing some headwinds, and at the time you are listening to this, the UK spending review will have been announced. so we will likely cover the impact of this next week. However, what we have seen in the UK is a rise in unemployment in the latest numbers and a slight increase in retail sales. The Office for National Statistics reports that the headline unemployment rate rose to 4.6% in the 3 months of February to April 2025, the steepest since mid-2021. However, on the positive side, the economic inactivity rate dipped to 21.3%. Cooling demand for labor is now visible in both headcount and hiring data. In the data, payrolled employees fell by 55,000 between March and April, and on provisional figures by a further jump to 109,000 in May, the sharpest monthly drop since the early stages of the pandemic. Despite the scale of this was somewhat expected given the national insurance and minimum wage increases which kicked in April. To the relief of some of the Bank of England Monetary Policy Committee members, pay pressures are easing too. Regular earnings growth, excluding bonuses, cooled to 5.2% year over year in February to April, with total pay at 5.3%. This is still higher than I am sure they would like, though, as real pay continued to rise, but the nominal slowdown is the weakest since Q3 2024 and starts to take wage pressures down. This could help to justify rate cuts ahead. Further supporting the prospect for a rate cut is that UK retailers just logged their weakest month of 2025. The British Retail Consortium KPMG Retail Sales Monitor, published on the 10th of June, shows total sales values up only 1% year over year in May, well below the January to April trend of roughly 2.5% and the slowest pace so far this year. With unemployment creeping higher and wage growth easing, May's subdued retail showing strengthens the case that the UK consumer engine is losing steam after the UK's first quarter surprise 0.7% GDP bounce. This further supports the prospect of a rate cut from the Bank of England. So, what else have we got happening? Well, I am actually recording this at the Global ABS conference, where the European Securitisation market gets together every year in Barcelona. This year is shaping up to be relatively positive for the industry, with over 5,000 people here in attendance. There has been an increase in activity over the past 2 years, and this is being further boosted by the prospect for regulatory changes that currently punish and restrict the sector. These changes come as a part of the announced competitiveness focus of the European policymakers, as we have mentioned last week. The market has shown signs of expansion into new collateral types nonetheless. KBRA recently rated the first middle market CLO, a market that has been active in the US for a number of years. The tone here is relatively positive and hopeful, as market participants genuinely feel that it can help to contribute to support growth in Europe. The recycling of capital from steady cash-flowing assets into new capital projects should help to support an expanding economy. So, where does that leave us this week? With geopolitical factors still dominating headlines and impacting markets, this still raises the prospect for ongoing volatility to some extent. European markets have been proving to be relatively stable, although they are still subject to these broader market impacts. This has helped to keep the issuance pipeline open currently as we migrate closer to summer slowdowns. On the economic front, I feel that we are likely to start to see some economic data that will challenge us. We will need to look through this as the tariff impact begins to feed through into the economic data. On top of this, KBRA's Ken Egan and Karim Nassif have just published an interesting report titled Steady but Strained, Europe's Path Through Mounting Global Challenges. The report looks at various aspects of the European economy, such as financial conditions, labor and liquidity, and the prospects for project finance. Take a look at it. It's a worthwhile read. That's all for this edition of the Credit Compass. If you found this episode helpful, please like, subscribe, and share it with friends and colleagues. Have a question or a topic you'd like us to cover? Well, get in touch. We'd love to hear from you. And for more in-depth financial research and credit ratings, please visit us at kbra.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.